Before we get underway, today's podcast is general in nature and not specific to your circumstances and should not be considered personal advice. Hi, my name's Paul Nicol, Managing Partner of GFM Wealth Advisory. On today's podcast, we have Kieran Moore, who is a partner and a portfolio manager at Munro Partners. Today, we're here to talk about two investments that we at GFM Wealth heavily support with Munro. The Munro Global Growth Fund, which we use the ASX-listed version under the stock ticker MAET, otherwise known as MAET, and the Munro Climate Change Fund, which is also listed on the ASX under the code of MCCL. So good morning, Kieran. Thanks for joining us.
Thanks for having me, Paul.
So firstly, Kieran, tell us a little bit about yourself and tell us a little bit about your journey at Munro.
Yeah, so I've actually been with Munro since we started in 2016. So when we launched the business almost 10 years ago, we wanted to create an opportunity to bring a global growth equity stock picking process to, the clients around Australia and now in Canada as well. So I've been here since we started, so know the business, know the process pretty well and happy to sort of talk through our positioning and outlook and things like that.
Terrific. And a little bit about Munro. So what I know about Munro, you mentioned you're a global growth manager. I know you have your main office here in Melbourne, another office in Toronto, around 30 staff, and you have a partnership model, which I think is relatively unique. Can you talk to us about the partnership model?
Yeah, absolutely. It's a great place to start. So what the partnership model enables us to do, and this creates what we think is a really good alignment of interest between what we do in terms of managing the money and what clients of yours want to expect from their returns over time when they invest with us. And what the partnership means for us is that it enables us to really go out into the marketplace and attract and retain really good people and move those people away from sort of that traditional salary and bonus structure to what is now a salary and profit share structure. Yeah. And we think this model works really, really well, not only to get great people into the business, but to keep great people working for the business over a long period of time. And therefore hopefully generate better returns for clients at the end of the day. So it not only aligns our interest with clients, but it aligns our interest internally. And we think, if we go back and look at some of the best funds management businesses from around the world, companies like or partnerships like Baillie Gifford and others, this is a really, really well-trodden path, and it's a model that we think works really well.
Terrific. So when I think about managing a global portfolio, what I know is that there are 25,000 odd stocks in that universe. Now, I know the Munro Global Growth Fund, for instance, runs a 30 to 50 stock portfolio. So how do you manage this universe? How do you start to break down what is such a big opportunity set?
Yeah, that's right. So we've got a lot to look at. There's a lot of opportunities out there. And what we actually believe fundamentally at Munro and what we really try and instill in our portfolios is we believe the market's actually a game of there's lots and lots of losers out there and actually very few key winners. And so what we do day in, day out, and this is symptomatic across our entire portfolio or our entire product suite, is we look at the world through what we call areas of interest. So an area of interest for us is effectively an area of structural growth. So things like, climate change with decarbonisation, a big opportunity over the next 10 plus years, or things like, payments moving from physical cash to digital cash. That's an obvious structural shift that has happened over a long period of time and presented some great investable opportunities as a result of that structural change playing out. So we look at these portfolios and we look at the world through these areas of interest or areas of structural growth. And we believe that finding structural change is really, really important. And I'll tell you why. So we looked at a study. This study was in the Journal of Financial Economics. It's almost 10 years old now. It was written by a guy called Henrik Bessenbinder. And what he did was he analysed the buy and hold return of every stock in the market over a period of 90 years, roughly 25,000 companies. And what he concluded was that the entire wealth generation of the market of the S&P over that period of 90 years was driven by only 1,092 stocks. The entire return set was driven by only 1,092 stocks, about 4% of companies. And so if you look at those stocks, that 1,092, all of those stocks benefited from a structural change in their industry over time. So things like, Boeing pioneering long-distance aviation or Home Depot being a leader in big box retailing, or McDonald's in quick service restaurants. All of those companies, those very few winners in the market, benefited from a structural change. And so what we do is we try and find the very few winners. And so to do that, we think you've got to look at the world through this lens of what's structurally changing in the world around us, through these areas of interest, these areas of structural growth. And in those areas, we try and identify the companies that are bottom up, i.e. the companies that are enabling those structural changes to play out. So if you think about the digital payments example, MasterCard and Visa can clearly grow and allow digital payments to happen all around us in the world today. So that's the sort of example of a company that we're looking for out of the myriad of companies out there in the listed universe.
So it seems incredibly logical to me to break down such a large universe into areas of interest, or to areas that have a structural tailwind. At a company level, what are the characteristics? So once you've identified those areas of interest or those structural tailwinds, what are some of the characteristics that you're looking for in a company?
Yeah, and this is really important. So at Munro Partners, what we've done over a long period of time through our investment process is we've built up a process that seeks to identify, we think, 6 really important characteristics for any great growth business. So our job is effectively to find, what's coming next. What is the next, as I said, big wealth generator for the market over the next period of years in markets. And so we think there are 6 really important characteristics that we look for time and time again when we go and jump on a plane and go and meet companies in the US or Europe or Southeast Asia. And we're looking for these 6 characteristics. And so the first one is growth, right? That's pretty self-explanatory. We're investing in growth businesses. We want to find companies that are growing, and growing faster than GDP is the threshold for us. The second thing is we want to find companies that can leverage that growth, and this is really important. So we want to find companies that can expand their margins or grow their margins faster than their revenues. So that means they have some kind of competitive advantage or pricing power where they can grow their profitability at a faster rate than their sales. The third thing we look for is durability of growth. So what we're looking for there is things like, how big is the total addressable opportunity? So maybe to give you an example, if we think about the structural change of e-commerce, right? That's retail shifting from in-store to online. There's a total addressable market associated with that. So when you get to full penetration of retail being online, that is the total addressable market being fulfilled, if you like. So what we want to find in companies is that they have a big total addressable market, or they're solving a big problem, or they've got a big opportunity in front of them. The fourth characteristic is we like to invest in companies that are effectively what we call good corporate citizens. That is, we have a ESG scoring process. We look at their environmental impact, their social impact, and some of their governance factors. We've built up that process in-house, and that's an important part of the process. The last 2 factors, Paul, I think are really unique to what we do at Munro Partners, and they're really unique to finding great growth businesses. So the second last factor is what we call alignment or control. So I said at the start the podcast that we run a partnership business, and I explained that creates a better alignment of interest. When we're investing, we actually want to look for the same thing. So we want to look for companies that have a high degree of alignment between the management team and the shareholders, because that's going to create better outcomes over the long term. We love to invest in businesses with founders still involved and founders that own big portions of the equity. Because they can think much more long-term rather than just the next quarter or the next report, things like that. The last characteristic of any great growth business we think is paramount to a good investment case is that the company has a great product. So customer perception of the product is really, really important. And so for customer perception, we're looking at things like review data. We're looking at what people say about the good or service that the business is producing. Love Elon Musk or hate him, the Tesla car is actually a pretty good car. The iPhone is actually a really, really good product. And so these are the sorts of research and this is the sort of edge that we're trying to build when we look at things like customer perception.
Fantastic explanation, Kieran, and again, very logical to me. Slightly curly question. We talk to portfolio managers about what are the characteristics of the styles of the type of companies that they're willing to buy. I guess a question to the flip side. What's the sell discipline at Munro? What happens if you end up with a company and it's not looking like what you thought it was?
Yeah, great question. This is really important because remember, as I said, the equity market's a game of very few winners and lots of losers. So we need to have a process to be able to recognise when we might have made a mistake. We've got one of those factors wrong, we've mismodelled the company, or we've got our timing wrong, we've paid too much, et cetera, et cetera. So what we have when it comes to selling a position for our portfolios, there's really two things that drive that decision. The first is that the investment case is played out, right? So that's a really good outcome. We've generated what we think is a good return on the position, and therefore we're going to sell the position. And so what drives that decision is we set price targets for all of our companies. We determine mathematically how much earnings they can produce, or how much EBITDA or how much free cash flow they can produce over a certain period of time. And then we put a multiple on that EBITDA or that free cash flow or that earnings. And that together equals your price target. So when a company's stock price hits the target price that we've set for it, that's potentially a catalyst for us to either go away and try and find more upside or sell the position. The flip side of that is that pragmatic process around managing risk. And this is really, really important. What we do at Munro across all the products, so this is not just a Munro Global Growth Fund phenomenon for the absolute return fund. We do this in the Climate Leaders Fund as well, is we have a proprietary what's called stop-loss process. Yeah. So if a stock, Paul, has a 20% drawdown, so that is if we buy it and it draws down 20% from its cost, or if it draws down 20% from the peak price since we bought the position, we have an automatic review of it. So even if, let's say, we buy Amazon shares at $100, they go to $200, and then it draws down 20%, we'll still review that position even though we're very much in profit on that position, if that makes sense. So what that review entails and what that practically means is that the individual stock champion the individual team member responsible for the research pack and the research and the modelling that goes into that position, under a review process, they have to effectively defend it to the rest of the team. And so if one person disagrees with that defence, we have to move it on. So we run this really rigid and tight stop-loss process to really help us manage when we might have got something wrong. And so for your clients, at the end of the day, what that ultimately gives us, or what that ultimately gives the clients, is a process where we run our winners for longer and move on from our losers as quickly as possible. Yep. So we don't hold things all the way down. We're actively managing and trying to create that really asymmetric upside scenario for the portfolios.
In fact, in the near decade that we, GFM, have been dealing with Munro Partners, one of the things that I've come to understand very well is your capital preservation mindset, or this desire to smooth returns via the cycle. So you've spoken about stop losses as one potential way for that capital preservation mindset to come into play. Are there other things now, probably specifically talking about the Munro Global Growth Fund here? Yes, yeah. Are there other things that you do around capital preservation?
Yeah, absolutely. So the Global Growth Fund is, remember, the objective there in that portfolio is to give you the double-digit returns through the cycle, so over sort of a 3 to 5 year period. So to get that double-digit return over that time frame, ultimately it's in our interest not to lose too much money.
Of course.
So we have the ability to use what we call capital preservation tools. So the stop loss is a good example there, where it contributes to minimising the downside on certain positions. But we also have other tools available to us in that portfolio. So we've got the ability to hold more cash in the portfolio. So what that means is that if you're an investor and you invest $100 into the portfolio today, we might actually only put 60 or 70 or 80 of that 100 to work in the market.
Yeah, you don't want to buy for the sake of buying, right?
That's right. So it depends on our view around what's happening in the world and the risks that are out there at the time. So we might only put a piece of that to work. So that is, we've got the ability to hold more cash. And so that means our net exposure, the exposure that the clients get to equity markets, can be less than 100%, if that makes sense. So if I put that 60 to work, my net equity exposure is that 60%. We've also got the ability to short sell. So that is obviously profit from businesses when their share prices are falling. We've got the ability to use things like put options. So they're very much like insurance type securities, where we would spend a very small amount of money for the portfolio. We would go and buy an S&P or a put option on a particular stock. And then if that particular stock or the S&P were to fall, then that put option has the ability to increase in value quite quickly. So they tend to sort of balloon in value when the option starts to pay off. And that offers really good downside protection. This is something that worked really well during the COVID period. It worked really well in Q4 2018 when the Fed was hiking into a slowing economy. It worked well for us in 2022, and then has worked well for us in the recent tariff volatility. So those capital preservation tools, all in conjunction, work together to try and smooth the volatility that we're delivering to clients in the Munro Global Growth Fund when things do get really tricky in equity markets. Because inevitably, when we've got some of those macro issues out there, things do get volatile from time to time. And all we're trying to do is try and manage the bumps along the way.
Yeah. So one of the things, actually, it would be remiss of me not to say that the Munro Global Growth Fund, and I'm talking about the ASX-listed version, MAET, has achieved that double-digit return, 13.8% per annum. One of my perceptions of my dealings with Munro is also you're always looking for the edge, the next way that potentially you can generate returns for investors as to the way you go about investing. I couldn't help notice last year you launched a global mid and small cap fund.
That's right.
I'm not here necessarily to talk about that fund because our clients aren't investors in that, but I just wonder if that capability that you've built in the mid to small cap area, whether there's any benefits that the Global Growth Fund gets out of that.
Yeah, absolutely. There certainly is. And so when you think about global growth investing and when you're thinking about what we're doing, we look at the world through these areas of interest or areas of structural growth. In those areas, there's companies like NVIDIA that has a market cap of $4 trillion plus, and there's companies that are much smaller than that, obviously, that have market caps anywhere, down to sort of that 5, 10, 15 billion type range. So what the small and mid-cap strategy allows us to do is it allows us to actually take some of the best ideas from the smaller part of the market, the emerging opportunities in those structurally growing areas of interest, and actually put them into the Munro Global Growth Fund. And so what's really important about this, and it comes back to the team structure, which you touched on right at the start, comes back to the partnership model. What you often see with different funds management businesses is they might have a small mid-cap team over here, and then they've got their big-cap team over here.
Yep.
And there might not be a lot of synergy between the two. And so our team, we've structured it in that way under that partnership structure where it's the same team managing the Global Growth Fund, the same team managing the Climate Leaders Fund, and the same team managing the SMID portfolio. And so we can take the best ideas out of all of them and put them across the different strategies at Munro. So there's been plenty of examples over the last 12 months since the SMID portfolio, small and mid-cap portfolio, has been around, of the Global Growth Fund benefiting from some of those positions, and certainly happy to give you a couple of examples.
Great segue. So I'm really keen now to get a little bit granular around these areas of interest within the Global Growth Fund. I read your last report, and one of the areas of interest was connectivity. I read stuff like AI stack, hyperscalers and the like.
Yeah.
Can you break this down for me a little bit?
This is a really exciting space and we think an opportunity to invest in what we think are going to be great investment opportunities over the next 3 to 5 years. And this is an area that is accelerating around us. So a super exciting area. So when you think about AI, what we know now is that AI has effectively had its iPhone moment, so to speak. Yep. So when you go back to the mid-2000s, the iPhone came along and it exploded and it got into everyone's pockets, and we all started, using Facebook and doing our banking on the phone, and now we're ordering Ubers and doing all our social media, et cetera, et cetera. So a really powerful tool. What we saw a couple of years ago is ChatGPT came along and it got to 1 million users in just 5 days. So AI had its iPhone moment. And so what we expect all over a long period of time is that every consumer in the world is going to interact with some sort of AI application. Every business in the world is going to try and leverage AI or use an AI application at some point to improve productivity, to improve efficiency, to get better outcomes effectively. And so what we do is we say, okay, well, that is a great structural thematic that's going to play out over a number of years and potentially provide great investment opportunities. And so the two areas of interest that we have dedicated towards this space, the first one is called high-performance computing.
Yep.
And the second one, as you said, is connectivity.
Yep.
And they do overlap a little bit. But what these two areas are focused on is, we think, the critical enablers of the AI boom, which are the semiconductor companies.
Yeah.
So what we did a couple of years ago is we detailed out, and you might have seen the graphic from us in our presentation, is we detailed out what we call the AI stack. So we created a bit of an upside-down pyramid, so to speak, of all the applications, the AI applications at the top. And then we worked out, well, what are the companies in behind those applications that are going to enable them to exist? The semiconductor companies are the critical companies that are going to enable those AI applications to exist. So companies like NVIDIA, companies like Broadcom, companies like TSMC, Taiwan Semiconductor Manufacturing Company. There's lots of different opportunities here to go for. Now, one level above the semiconductor companies at the bottom of that AI stack is what's called the hyperscalers, what you said, the hyperscaler companies. Now, these companies, what they are effectively the Alphabets of the world, or the Google, Meta, Amazon, Microsoft, and now Oracle as well. And so they are the companies that are investing in data centers, building big data centers all around the world, heavily in the US at the moment, building big data centers where these semiconductor chips go into. And it's the data center that is the big critical piece where all the compute power happens for us to be able to use AI in the future. So if AI is going to be in the center console of our Toyota or our Tesla or our BMW, the compute power that's enabling that application to exist is probably going to come from one of these big data centers.
Yeah, terrific. We have to talk about NVIDIA, or at least I'm keen to talk about NVIDIA. To the absolute credit of Munro, you guys were a very early investor in NVIDIA, and it's been a terrific position within your funds. It's the biggest company in the world also as well now. I'm really keen, just for our clients, just a quick 1-minute overview of what NVIDIA does and what your investment thesis for NVIDIA is right now, because it is still the largest position in the Global Growth Fund.
That's right. And it's hard for me to distill it down to 1 minute, but I'll give it a go. So NVIDIA, again, coming back to the process, NVIDIA has all those characteristics we're looking for. It's got the founder. Jensen Huang, the CEO, founded the company. So it's got that ability to think much more long-term about the big structural opportunity, which is AI. So what they do is they effectively design or create GPUs, which are graphics processing units. They are critical to all those applications for AI. So if we want to use an AI application like a ChatGPT or like a Perplexity, if any of the listeners have tried that, or Google Gemini, those sorts of applications rely on NVIDIA chips getting that really good outcome for us. So for AI, for us all to use it, it's got to work. So it's got to give us good outcomes. The large language model, the ChatGPT's got to answer the question correctly, and it's got to do it relatively quickly. So what that means is you need a significantly higher or more advanced form of compute power happening in the background to process that information, for it to learn all the information and then deliver that outcome to you. So NVIDIA provides the most technologically advanced chips for the data center to enable those applications that you and I use day in, day out, and that give us those good outcomes. So they are the critical thing, the shovel in the boom for AI.
Are you convinced NVIDIA's chip can remain the most technically advanced chip going forward?
Yes. Yeah, we are. We certainly think there'll be alternatives, and they might not hold their very, very high market share today, well into the future. But we certainly think there's a path forward for NVIDIA to double their earnings over the next 5 years. There's a long runway of growth here. So maybe just to give you a couple of quick anecdotes, the big customers for NVIDIA today, as you said, are the hyperscalers. So that's Google buying the chips, Microsoft, Meta, Amazon, Oracle. On top of that, now these guys have a long runway of what they're going to spend here. But on top of that, we think sovereigns are going to buy NVIDIA chips. So we saw more recently some big announcements in the Middle East with President Trump. And we saw the European NVIDIA technology conference a few weeks ago as well. So sovereign governments are going to buy NVIDIA chips for their AI processors. We also think there's a big opportunity in things like robotics, which is going to need that more advanced compute power. So the runway here for NVIDIA to continue to grow and to leverage that really strong competitive position is we think, pretty compelling.
Terrific. Moving away from connectivity or high-performance compute, I see one of the other areas of interest in your portfolio is digital media and content. I think this is fascinating. It's in our faces, isn't it? You have positions in companies like Meta, Netflix, Spotify. Can you talk to us about the tailwind opportunities in these businesses?
Absolutely. So the first thing I'll say is that when you think about global growth investing, what we do at Munro Partners, remember, there's a big portion of growth investing involves, semiconductor companies and technology companies. But remember, there's lots of other opportunities. So there's media and content businesses that can be great growth businesses. There's industrial businesses in climate that can be great growth businesses. So growth investing doesn't always have to be technology and semiconductors and things like that. So content businesses, we think, provide really strong opportunities to invest in high quality growth. So if you look back at some great growth investments over the long term in markets, one of the better growth investments out there over the long term has been a company like Disney that ultimately had great content that attracted all those eyeballs. Attracting all those eyeballs from consumers is very, very powerful. And so Netflix, we think, is the next iteration of Disney. Spotify is a great content business. And that business has the ability to leverage its very, very big user base over a long period of time. Meta attracts billions of eyeballs each and every day to the platform, another great content business. But the evolution of content for us also includes things like sports content. So in the Global Growth Fund, we own Formula One. So Formula One is the sport. So we think Formula One, and so the business we're investing in tracks the performance of the sport. And so we think Formula One is relatively underappreciated versus the opportunity. The rights are very small in the US, and if you compare it to some of the other big sports, very, very small fraction when you compare it to the value of those other sports in the US in particular. And now also what F1 are doing is they're controlling their own races. So people would have seen the Vegas race that started a couple of years ago. What they're doing there is they're controlling the operational footprint of that race and therefore participating hopefully in more of the economics. So we think it's an underappreciated content or underappreciated sports business. And so this is another example of a differentiated growth idea to go into the mix alongside some of those technology opportunities.
Great. And while we're focusing on differentiators within the portfolio, I think one that will resonate with our clients is innovative health. Particularly, I read about your exposure to the GLP-1 drugs and potentially opportunities in companies like Eli Lilly. I know you've got Novo Nordisk and the like. Can you talk to me a little bit about that?
Yeah, so the GLP-1s is effectively, again, a very differentiated opportunity for investment. So weight loss is actually, or weight is actually a chronic condition. So obesity is a chronic condition. It affects close to 1 billion people around the world. What we have today is basically a very, very small subset of that billion people being treated with pharmaceuticals. And so when you think about going back to the 6 tests, when you think about durable growth runway and a big total addressable opportunity, the opportunity here is for companies like Eli Lilly and companies like Novo Nordisk that are now producing drugs that can lower your weight, that are very easy to administer and affordable. They now have the ability to penetrate that close to 1 billion people with a pharmaceutical drug. So treating this chronic condition in the past has been, sleep better, eat better, exercise more. Now we have drugs produced by two companies, a Danish company in Novo and a US-based company in Eli Lilly to treat this opportunity. So we think that we're at the forefront of a big runway here of growth. Now, what Eli Lilly is doing is something really, really fascinating at the moment, is they're bringing an oral form of the GLP-1 drug to market.
So instead of an injectable.
Exactly, yeah. So these drugs used to be injectables. They were done through a pen.
Yep.
That's fairly, easy to use and well understood. But now they're bringing an oral form of this drug to market. And we expect that oral to reduce weight by anywhere up to about 15%.
Yeah, wow.
It's due to have a study readout soon. So we'll see what it says, but we expect it to be up to about 15% weight loss, which is pretty meaningful.
Significant. I guess we all hear about Ozempic, but it seems to me like there are significant developments in this area, and maybe we're still even at the embryonic stage of development for weight loss drugs.
There's a lot of runway here to go for, we think. Now, coming back to the actual stocks themselves, what the stocks have done is that over the last couple of years, Novo Nordisk in particular, is that they've had a difficult time supplying the market. So the demand for these drugs has been sort of insatiable, so to speak. Lots of different people are trying them. There is potentially a therapeutic application for these drugs down the road. So they've had a really difficult time supplying the market. And so we've actually exited the position in Novo Nordisk under that stop-loss process, under that review process. It's a position that's done really well for the portfolio over a number of years. But we've exited it late last year, and that's because they've had a really difficult time supplying the market and we're losing share as a result. So we still own Eli Lilly today, which we think is a good opportunity moving forward.
Great. And I think one of Munro's largest areas of interest is in climate, or can I call it decarbonisation? Is that fair?
Yeah.
And I'm really keen to hear about, and I think this will be a good segue to talking about the Munro Climate Change Leaders Fund, but I'm really keen to hear about the thesis behind investing in climate or decarbonisation.
Yeah, so this, again, when you think about structural growth opportunities, this is a big runway for growth.
Yep.
So we expect the world to try and decarbonise over a long period of time. This is going to take 10, 20, 30 plus years.
Yeah.
So what that means for us is our job is simply to go out, look at the opportunity set and work out which of the companies that can grow their cash flows or their earnings from providing a solution that helps the planet decarbonise.
Yep.
And so we think it's a great time to invest in this space now because effectively, and we've been talking about this for a while now, is effectively you've got some big tailwinds coming together.
Yeah.
So investors are now allocating capital towards this space. Yep. Governments are now making big commitments in this area, and corporates are now making big commitments in this area. So these three tailwinds are sort of coming together at the right time, meaning that there's an acceleration happening for companies that provide solutions to help decarbonise.
Yeah. This can be a very emotive topic, and some will debate the sciences. I'm not here to debate the sciences. It just seems inevitable that corporates, households, countries and the like are moving towards net zero.
That's right.
Fair call?
That's right. Yeah. All we're trying to do is work out where the money's going to go. So there's going to be lots and lots of dollars spent at this opportunity, somewhere we think in excess of $50 trillion globally to try and decarbonise. And all our job to do as a growth investor is work out where that money's going to go, what sort of companies, what sort of industries, what sort of regions, what sort of sectors, and then invest in the companies that can grow their businesses because they help provide a solution here.
Yeah. So, a lot of our clients that invest in a strategy or are contemplating investment in a strategy do express a degree of nervousness around this thematic or area of interest, and particularly with respect to President Trump and his views for climate change. How do you counteract that argument?
Yeah, absolutely. It's a really good question and something we have to think about. So remember, our portfolios are very dynamically managed. So we do actively manage these areas of interest. Remember, we have the stop-loss process as well to help us pragmatically address any issues that come up along the way. Now, in the climate fund in particular, it had a very, very strong 2024 and it's off to a great start this year as well. Now, a key reason for that is clearly the US administration is or has taken a somewhat negative stance towards things like pure renewables and EVs, so to speak, or electric vehicles. But there are other areas within the climate agenda that can benefit from both parties. And it actually doesn't matter who's in power. So where we've focused a lot of our time is in things like nuclear energy, for example, which is and has been, somewhat of a difficult conversation here in Australia.
Yep.
But in the US, we're actually going through what we think, and globally actually for that matter, we're actually going what we think is called a nuclear renaissance. So countries are committing to nuclear power, which remember is a very low greenhouse gas emission form of power, but can deliver high capacity loads. So a really important transition fuel to help us get towards net zero over time.
Yep.
Now, what's really important about nuclear is that both the Democrats support nuclear and the Republicans support nuclear. And some of the best performing stocks in both the Global Growth Fund and the Climate Leaders Fund have been around this nuclear opportunity within climate change. So we've very much positioned the portfolio in areas within climate, within that area of interest, that benefit from both Republicans and Democrats, and it doesn't really matter who's in power.
Okay. So I'll take a step back. When focusing on the Climate Change Leaders Fund, that's your area of interest. I'm really keen to understand how that you construct a portfolio underneath that, because I think you have then what you call sub areas of interest within the area of interest.
Right.
Have I got that right?
Yeah, so that's right. So this one is so big and is such a compelling opportunity, we think, on a long-term view, that we've broken it down into, under the surface, what's driving that area of interest. And so we've broken it down into effectively four areas. So the first one is obviously clean energy. That includes the renewable companies that can, provide those solutions. That's also where the nuclear sits. We also include things like the circular economy is another subthematic. So that includes packaging, waste, and water. We also include a subthematic called clean transports. So that is clearly dealing with EV companies, but it also includes charging infrastructure and battery technology and all those alternative forms of energy storage, for example. It addresses that whole part of the market. And then the last one is probably where we've had the biggest exposure over the last sort of 12 months or so in the Climate Leaders Fund is energy efficiency. And so energy efficiency is probably what we think the biggest beneficiary of all that money being spent. And this is focused on things like heating, ventilation, air conditioning, buildings efficiency effectively. So one of the biggest energy uses out there is heating, ventilation and air conditioning in buildings. And so if we can address these sorts of problems from a carbon footprint point of view, we can go a long way to helping the planet get towards that, reducing carbon goal.
Yeah, on the topic of energy efficiency, hearing what you're saying about heating, I think it's a well-known fact, and I guess there's a bit of an intersection here between the discussion we're having with AI before and with climate. I'm probably specifically focusing on data centers and that they can be big energy chewers.
That's right.
Or the hyperscalers. So how do you go about finding the winners there with energy efficiency in this intersection with AI? How do you go about doing that in the Climate Change Leaders Fund?
Great question. So what's happened here is that climate change is a big problem in and of itself, right?
Yeah.
We've got a massive opportunity here over a long period of time. But now what's adding a complexity to the power dynamic, particularly in the US, is that, as you say, Paul, the hyperscalers are building all these AI data centers, which are hugely compute intensive and therefore hugely power intensive. So things like nuclear play a role here in helping solve that equation. So if you think about it, a typical query on a large language model, on a ChatGPT, uses 10 times the power that a traditional Google search does, because the compute process is more intense.
Sounds logical.
Yeah. So what we have and what the Climate Change Leaders Fund has benefited from is companies that help solve that narrative. So managing the added complexity that AI is placing on power networks. So that is, companies like Quanta, for example, that's been in the Climate Leaders Fund, that provides grid services and helps upgrade electrical grids in the US that are now under a lot of pressure. It's also part of the nuclear dynamic. So one of our big holdings, Constellation Energy,
I was going to ask,
is the largest operator of nuclear assets in the US. This company has actually made partnerships directly with Microsoft.
Fascinating.
And now Meta more recently in the last couple of weeks. And so they're partnering directly to supply those companies with nuclear power to manage that data center.
So it's obvious that the Metas and of the world and the Microsofts of this world are sensitive to the data centers and them being energy emitters and high energy emitters. And
absolutely. So they, by virtue of being good corporate citizens, remember back to the 6 qualitative steps, they're not going to power these data centers with, burning coal or something like that. Natural gas can potentially play a role here, and it's something we have investments in the Climate Leaders Fund. Natural gas can play a role, but the principal role is nuclear because, as I said, it's got that low emission form of energy, but it can deliver high capacity loads of energy as well.
Yeah, great. This has gone very quickly. We're nearly out of time, but I have to ask you about clean transport. I want to talk to you about EVs.
Yep.
Curious to know whether you own Tesla in the portfolio or how you look at EVs. I know you spoke about EV batteries and the like.
Yep.
Bring this all together for me.
Yeah, so we're finding some opportunities around battery technology. We do have some investments in that space in the portfolios, both the Climate Leaders and the Global Growth Fund at the moment, and some emerging opportunities in that space. But EVs, the traditional manufacturers of EVs, the actual OEMs, so to speak, the car companies, we've actually had a negative view on for the last couple of years, really, and that's mainly due to the fact that we've seen a lot of competition in that space. So we've seen the Chinese EV manufacturers really gather market share and build a lot of momentum. And what that's doing is it's putting pressure on prices. And so the earnings for the EV companies, Tesla is Tesla is caught up in this, is they're lowering prices in the industry. The industry is becoming increasingly more competitive and therefore their earnings that they're going to produce as a company is potentially under question. So we don't own Tesla. We haven't for a number of years, and we don't own any EV manufacturers, but we are finding opportunities in areas, things like battery technology.
So I know you don't own Tesla, but when it comes to, let's say, autonomy or autonomous driving, how do you look at this?
Yeah, so we've got a couple of opportunities here actually, and they're not secret, small opportunities. They're actually in some really big companies, and the first one is Google. Waymo is a big part of Alphabet, of Google. That is a business that it's currently loss-making, but what it's doing, it's gaining meaningful market share. So it's doing roughly 35,000 rides each and every day in the US at the moment. So this is a business that could be $100 billion plus business at some point in the future, and it's inside Google today. The second opportunity we think is Uber. So Uber has a big opportunity in autonomous vehicles. And we don't think Uber is a loser from autonomous vehicles. We think they're actually a beneficiary. So we think, will be a big distribution platform for autonomous vehicles in the future. So when you go on the Uber app, which is typically a front page app on most people's phones, you might order an autonomous Uber or an autonomous Waymo or something like that, or you might order a traditional Uber. So that's the natural distribution platform for autonomous vehicles to attach themselves to hundreds of millions of consumers around the world.
Yeah, fascinating. Kieran, I could talk with you all day about Munro and about the portfolio positions, but we are out of time. I've got to say on behalf of our clients, thank you and congratulations. The Munro Climate Change Leaders Fund, the returns, the results since inception and over the last couple of years have been phenomenal, and the Global Growth Fund since 2016, outstanding. So on behalf of our clients, thank you to you, Nick, and the team, and especially thank you for your time today.
Thanks a lot, Paul, and we certainly appreciate the support.
Cheers, mate.